Hello, good morning, everyone. Excuse
Good
me. It's
morning.
our pleasure to have you on board, just to share tidbits of investment. As Chidera rightly said, Sa'id Kolapo, product development and partnership with FSDH Asset Management. So FSDH is an acronym for First Security Discount House, and we deal solely with investment products with minimum range of 5K to hundred of millions. And of course, we have vested, making everything easy, so simplified. I'm sure everyone here at this training today has been on the app at one point or the other to make investment, and you agree with me, it's so simple to get it done. Either you want to do the investment thingy solo, or you want to do with a family member, with your partner, just live up the burden. Vested is suited for this purpose, right? So this is Saturday. I know we have other things to do, so I'm just going to dig in straight up, right? So what is investing? I want to make the class as interactive as possible. Um, Anybody want to tell us what when you hear investing, what comes to your mind? It can be a word, it can be a line. If there are no takers, then I will proceed. But I'd love for us to make the class very interactive. Chidera, Chidima, feel free to jump in at any time, to encourage the audience to. So when you say investing, when you hear the word investing, what comes to your mind? Oh, sorry, quick one. I'm sharing my screen. Is it visible?
Yes, it's visible. Can hear you. Good
Awesome.
morning. I can see it
Yeah.
as well. Yeah.
Okay, awesome. Thank you, Sandra. So when we say
Okay, Said,
investing,
can
what
you hear
comes to
me?
mind? Yeah, go
Let me
ahead,
try
Shidera. I can
and
hear you.
okay, so investment to me or investing to me is putting your money into things like shares or stocks or bonds to make more money. I mean, that's the way I understand investing. Or using your money to make more money. Put your money somewhere so that it can yield returns for you.
Awesome. That's just it. It has just one definition. Making your money work for you, growing more money, you know. Some people even say it's making money while you sleep. So the concept of the way it is set up is you make more money when you work actively. So meaning you need to put in the time to make this money. That's why we're employed 9 to 5. We have our own business, entrepreneurs. But the concept is investing is you're making this money even where you're not working actively. So that's why some people say your money is working for you even while you sleep. And that's the concept of investing. So investing is just growing your money no matter how little it is. Because you agree with me, I have 100,000 at the beginning of the year. At the end of the year, I have 140,000 or I have 110,000. Then that increment, it's not what you can easily overlook. It's actually growing your money. If you want to go in terms of percentages, then you can calculate. However, the little value you've gotten off of your main capital, that is the whole essence of investing. And it's actually to make your money work for you so you can have the kind of lifestyle you want, or the aim is you have a target. Let me invest this money, I earn the returns and I put it somewhere else, and such that okay, my money is working, not directly doubling per se, but growing, right? So just our ground rules. If you have any question, because I'm sharing my screen, I may not have to I may not say it, so you can just type it in the chat box here. I'll take breaks at intervals, then we'll handle the question, then we'll move on. So Chidera, you can help me with that if the chat box is visible to you.
Sure,
So at any
sure.
point in time, just let me know if you have questions. So now that we've defined investing, right, or investment, we've gotten out of the way, right? It's just making growing your money. But there are things to note that I notice with, especially with early investors, things that tend to keep them back. Oh, I'm too old. I'm 40. When do you want to start investing? When do I make returns? Or, oh, no, I'm too young. I mean, I'm just 18. I'm 20. I'm 15. Why do I need to start investing? But you remember that saying, The best time to plant a tree was 20 years ago. The next best time is now. So if you've not started investing, now will be the right time to start it. So you're never too young to start investing. Invest as you earn, start with what you have. I get people telling me I barely make ends meet, I don't have the means, why do I want to invest? But you just start with what you have. That's where budgeting comes in. Then you have discipline and dedication to push you forward. I believe we all have one goal or the other we want to achieve, and we need money to achieve this. So that goal can drive us, or rather motivate us towards investing, right? And the last one I like to tell people, investing is not exclusive to financial experts. I've heard a lot of people say, no, I'm not an expert, or I don't know. They have long form I'm filling, or this app and that app. I don't even know what is happening. So I'm not an expert. I'm not going to invest. So they rather be, excuse me, they rather be conservative and save the money, right? But saving is not bad. We'll get there. While saving is just your money staying in the bank, getting AC and enjoying itself, but not really returning value for you. And we know how fast inflation is growing. It's currently, analysts said we have galloping inflation in Nigeria. So you don't want a case where you save your money and the value that that money can give you is eroded away over time due to inflation. That's the whole purpose of investing. So no matter how little the money has grown and can cover things. And having a goal, right, in life. Okay, great. Sorry about that. So having a goal, not about investing, about life in general, then drives people to want to go to extra mile to achieve this goal. It's like a set of rules. Oh, this is what I want. I want to buy a car. What is your time frame? 6 months, 1 year, 2 years? Some people go as far as printing the model of this car, having a picture and put it at the action point where I sit the most. Will it be at that corner of the kitchen where while I'm cooking I see it? Is it when I'm doing laundry? I get to see the picture to kind of motivate me. Or is it at work, at my workspace? I have a place at that corner, and when I'm having a hard time, I can look at the car and smile and say, oh yes, this is the goal. Excuse me, I'm coming for you. Do you want to go on vacation? Do you want to bag a degree? Or do you want to start a business? You're currently into 9 to 5. You're investing towards having enough capital to start your own business. Do you want to buy a house? Or for the parents among us, you want to secure your children's future. How do I cater to their school fees, their needs, given the rise of the cost of living currently? So when you have this goal, it kind of motivates you. It drives you to want to invest and do the right thing. So how do we do the investment right? So yeah, like we discussed, what's an investment? So I just need to clear the air a bit. Investment is not a Ponzi scheme. It is not MMM and the likes. It is not the same as savings. While savings might give you a little return on your money, it keeps it safe. But investing really puts you out there, gives you a lot of options in which you can use to grow your money. And it's not a get rich quick scheme. When you want to invest, it takes a lot of patience. It takes time before you start to see, shall I say, the result of this investment, depending on your principal. You agree with me? Someone that invested 1 million for 1 year will not get the same return as someone that invested 100,000 for 1 year. So that patience comes in growing the principal so we can start seeing the return, right? So investment is all what we said earlier, growing your money over time, making your money work for you, an asset intended to produce income or capital gains, an asset or item acquired with the goal of generating income or appreciating in the future, right? So investment is not all about putting your money in a bank or with an asset manager and locking it up. No, you have informal investment. I know a couple of people that currently invest in a car to use for carpooling, Bolt or Uber, and it gives some form of return. That's also investment, although it is informal and it has its risk. But I'm just trying to put it out there that investment's not about, getting the whole financial assets to move forward, right? So I just want us to quickly watch a video that will say investment. Then we can take it from there, just so I am able to show the points, the difference between saving and investment. Chitra, let me know if you can hear the audio. Chitra, can you hear the audio?
So your screen hasn't changed. It's still the deck that you're sharing.
Oh, still the deck. Okay. One sec. Okay. Okay. One sec. Let me initiate the sharing again. Okay. How about now?
It's coming up
Okay.
on my end. I don't know if other people can see.
Can anyone else see it?
Yes. Hello, Sa'id.
Okay.
Yes.
Oh, okay. Awesome. So the next question will be, can you hear the audio?
No, I can't.
Okay. Give me a second. Let me try to sort that out. So stop sharing. Yeah. Okay, I've initiated with the sound. Just let me know as soon as you can see my screen. Can anyone see it yet?
Yes, we can see it.
Yes, I can see the screen, but I can't hear anything. Okay, can hear it now.
Awesome.
Hindi ba? Ay!
ขอต้อนรับสู่รายการ
ออมโลกผ่านดาวเสาร์จนค้นพบโลกใหม่
เด็กคนนี้มีแววอัจฉริยะผู้ที่จะคิดค้นโลก
ป้าซื้อลูกชิ้นลูกหนึ่งได้ไหมครับ อ๋อ ไม่ได้
โ Okay. Thank you very much. Anybody want to tell me what transpired in the video or what they got out of the video? Hello, mic check. Am I still audible?
We can hear you. I was waiting for someone else to talk, but
Yeah,
let me
we
share
can hear
something.
you.
Okay, someone wants to go.
Okay. Yeah, anybody want to
Oh,
share what they feel happened in
well,
video?
I thought that video was the funniest video because I laughed all through. But then it came with a very important lesson, about what's that word? Is it delayed gratification? When you want something, you have to be ready to like if something's really important to you, especially when it has to do with something that you have to spend money to get. So you have to just avoid making you have to forgo your wants and then just focus on achieving that need. Yeah.
Spot on. Thank you very much for that. Somebody else want to contribute? Okay, Chidera, you may go now, so I'll take it from there.
So I just wanted to say something funny that after his stress and going through a lot, he wasn't still able to buy the thing like he had saved, but his money lost value, at the end of the day. So savings doesn't really cut it sometimes. That's what I wanted to
Thank,
say.
thank you
Oh,
very
is that
much.
what
Yeah.
happened? I thought that Said cut the video off because maybe he had spent so much time. I didn't know that that was what happened at the end. I thought maybe he finally bought it.
No, no, no. He was at the shop and he was daydreaming. Finally, he's in the rocket, lift off
Oh,
and everything. And just then, the shopkeeper changed the price from 2.5 to 3.5. So, which
oh
is the
my
reality
goodness.
of life. He has been so diligent, saving, like you said, delayed gratification. Didn't buy ice cream when his colleagues were buying. Didn't play game at the arcade. Didn't buy his favorite toy. Then, just at the moment when he filled up his piggy bank, inflation happened, or rather, there was an economic shift, and the owner of the shop had to change the price, which is what happens in reality when we save our money versus when we invest. If you had been investing, the returns, or rather, the interest you'll be getting over time, will have been able to cover that shock, if not completely, but to some extent that you won't have to wait that long to make that 1,000 again. That's why I keep saying, okay, savings is good, but investment is better. That's what the video is just trying to show us. And if we use the right, let's bring it close to home, right? The famous Corolla, the 2005 model used for Bolt or Uber, used for the transport system. I think it was selling 3 months ago, it was selling for like 4.2 million. And you have someone saving to buy that car. And with the new administration and floating of the Naira, which I'm sure we're aware, dollar shifted from 465 to 750, right? So what it means is that car will go from 4.2 million to like 6.5 or 6.8 million, rough sketch. So that is exactly what happened. They shifted the price of the goal. So meaning whoever is saving towards that car, we have to continue saving. And who knows what will happen when it gets to the end of the line. So, but if you've invested that fund, you have returns coming in, like you have interest, which might cushion the effect of the change. Yeah, but I like the fact that you pointed out delayed gratification, which is what goes with investment, the patience, and of course the instant gratification we want now, we have to be delayed or denied in some cases just to get it. It's getting interesting. So how do we? I am a novice, totally green leaf. How do I start to invest? Right?
I was raising my hand.
Oh, sorry, I didn't see that. Please go ahead.
Yes. So another thing I learned from the video, apart from deliberately making sacrifice, I think it also goes a long way to show that sometimes if we're interested in something, aka investment in this case, saving yes doesn't cut it, but asking for help, guidance, right? Because just like you said at the beginning of this call, a lot of people want to invest but don't know how to. So I want a car or I want a plane, and I don't know how to go about it. I don't have enough money right now. So I think if he maybe asked for help, or maybe there was some sort of way that there was Just like what you're doing right now. I've always wanted to invest, but I just don't know how to. Thank God Chidera reached out to me. Do you get? So another thing is awareness, asking for help or some sort of guidance to help you achieve your goals.
Awesome, awesome. I was actually clapping here, like, oh, good. This is just like a very, very salient point here. Reaching out for help. He was just saving independently, putting in his piggy bank. I'm sure if he had spoken to an adult at home, either of his parents, he'll have gotten a better way to achieve that same goal. So yes, and thank God we're here. um well, asking for help and we're giving it, right? Bested is there for you. It's so easy. You set your goal and what you want to achieve. So now, just to dig in, how do I even start to invest? The truth is you can't give what you don't have. So the first step will be to evaluate your financial situation. Okay, currently this is what I earn. What is the cost of living? How much do I spend? So at the end of the month, X comes in and Y goes out. The difference between them is what you can save or invest. And there's this popular saying in the investment circle that say, um, do not save what is left after spending, but spend what is left after investing. So it's the other way around. Most of us tend to spend, oh, we have needs, spend, 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 and oh, I have 10,000 left, I have 2,000, let me save or invest. But actually, it's supposed to be the other way around because the human mind is it's like the best machine, if you ask me. If you invest first and you decide to take what is left, trust me, you'll find a way to make it work. We're built that way. We're wired that way. Humans naturally are wired to survive. So we'll find the survival mode will kick in and we're able to allocate the other funds to our needs or wants. So you need to evaluate your financial situation. How do I get this done? Okay, sorry about that pause. So evaluate your financial situation. So how do I make this work? Identify your goals and you work backwards. Oh, I need to buy a car in 2 years and you want to save 5,000 every month. Then you ask yourself, is this realistic? What is my goal? And how much can I squeeze out from my current situation? I'm not saying you don't have big goals. In fact, it's better to have huge goals so you find a way to achieve this. So currently, I have one source of income. Can I take up part-time jobs? Can I do public speaking? Is there a service I can offer to increase my income stream so I can meet this goal faster, right? And like you just said, like the last speaker said, was engage a professional financial advisor. Because you may think this is not possible, it's too much, it's take a long time. A financial advisor will be able to break it down for you. Or you have the money, you're equipped, and at the end of the day, it will be sad to put it in the wrong sort of asset to invest. Then you need to design a plan. So when you're designing the plan, it's just working backwards from your goal. My goal will cost 1 million. So how do I achieve this within the time frame? Is my time frame 3 years? Is it doable? Do I need to achieve my time frame to? Do I need to increase my time frame to 4 years? Then you work backwards, then you can get the amount you need to invest with. Do I want to invest lump sum or do I want to invest monthly as I earn? So you need to have this plan, and we're here to help you design a plan which you can now tweak to achieve your own goal, because it's actually not a one size fits all situation. It is peculiar to one, your power, your earning power, right? Extra source of income, the time you have, your time horizon, your risk appetite, and stuff like that. But we get there. I don't want to jump the gun. Then you execute the plan. After first execution, you monitor, refine, and you repeat. So these are just high level steps to follow, right? Then if you now break it down, bring it close home, what is your monthly disposable income? So disposable income is just what is left after tax. If you're in the formal sector, if you're an entrepreneur, do you pay your rents? Do you pay a levy
Is it
to the
just
government?
me? I think Said is breaking up. Said,
Oh,
you're
I can
breaking
hear
up.
him
Can
clearly.
any other person hear him? Oh,
I
it's
can
Yes.
hear
just
him
me.
quite all right. Yeah.
Uh-oh, Chidera, you picked the short end of the stick. They can all hear me. So what is your monthly disposable, excuse me, what is your monthly disposable income after tax? So the easiest way to go about this for now, right? Then you can refine and see which works for you is apply the 50-30-20 budgeting rule. So out of the 100% of your income, you take 20% out of it for investment. You're left with 80. So out of that 80, you allocate 50% to your needs, then remaining 30 to wants. Some people say wants can wait. I can defer the gratification and put more to my investments. And going by just basic economics, which a lot of people might want to argue with, needs is food, clothing, shelter, and health. Every other thing outside that circle becomes wants. But like I said, it's not a one size fit all, right? So you can now fine tune this to see. Then after you use this 50-30 rule, it brings you to how much do you have to invest? If I take 20% of my earning now, so after investing, then I work backwards to apply it to my needs and wants. And that's where the argument comes in. What serves as a need to A might be a want to B, or what is a want to B might be actually essential survival need to person B. So the idea is to really study yourself and you apply this, right? So I'll pause here and see if we have any questions, because these steps are essential to getting it right.
No questions from my end.
Okay, thank you. I think we can proceed, right? So when it comes to investment, right, there's what really makes people like, yeah, I'm just trying to show the difference. So aside from earning interest from your investment, there's also another part called compound interest. So compound interest simply means adding whatever you make as returns, adding it to your principal, and you keep investing it running over. So I've invested 100,000, I made 5,000. I add that 5,000 to my 100,000. Now I have 105. I invested again, earn another 5,000 or 5,500, add it to the 105, I have 110,500 continuously. So what this table is just trying to show is the difference in 5 years if you're saving using the compound interest. If you're reinvesting the interest you make as opposed using it, that's where delayed gratification will come in. Depending on your investment style, some people invest the principal and leave off the returns and use it for to achieve their goal, right? As against spending the principal to achieve this. That is one. Then some people keep both the interest and the principal and keep rolling it over till they meet their investment horizon, their target. So scenario A is somebody investing 20,000 every month for 20 years. So they start with 20,000 every year. Total value of deposit is 4.8 million. Total value of interest is 9.8, and the value of investment is 14 million. All right. But for scenario B, the same thing. They just extended it by 5 years, and you could see the difference using compound interest, right? Because they're rolling over both the principal and interest, right? Meaning they keep growing the principal every month they get their returns, and you can see the difference. While the total value of deposit is 6 million as against 4.8 million, the value of interest is 19, because of if you take a look at the scenario, the principal keeps growing, therefore the interest will grow. Then when this is compounded and rolled over time, total value of investment is 25 million, right? So if you do 25 minus 14, that is almost approximately 10 million naira difference, and in just 5 years, which is even more than what the person in scenario A earned for the 20 years they saved. So like I said, it all depends on your investment style. Can I be patient? Can I be patient enough to invest the principal and keep rolling over both principal and interest? Or my style is I've invested this money in the principal, I can make do with the interest. And that's why it's actually very, very important when you consider compound interest. But it depends on the style you want. Every 1 year is good. There's no good or bad. It just boils down to the individual and how you think you can achieve this, right? So now coming to investment option proper, aside from saving money in the bank, and we've seen the disadvantage, you earn returns, right? But I'm saying you can widen the net. You have mutual funds, you have commercial paper, you have treasury bills, you have equities, bonds, real estate, right? I'm going to break each one down like so I don't use high level. These are high level languages, right? So what you start with is profile yourself. What are my investment objective? This is the same thing as the goal. We've spoken about it earlier. Investable funds. What is my disposable income after you take tax from my earnings? Then what is my risk appetite? Then what is my age? There's a whole section dedicated to risk, right? But I'll just speak on it high level. So risk appetite simply means how much, what percentage of my principal will I be comfortable letting go for as long as I'm guaranteed higher return? I'll take it again. So your risk appetite simply means what percentage of my principal will I be comfortable to let go of it as long as I'm assured higher returns, right? So let me use numbers this time. I'm investing 100,000 and the return says I'm making 30%, meaning at the end of the year I get 130% of my funds, right? I'm making 130,000. But the risk is, well, because the return is high, there's a possibility that I lost 10% of my money. I may end up with 90,000 instead of the 100 I put in. That is what the risk appetite is describing. Trust me, I'm an investor. I've been at it for ages. My risk appetite is zero. Thank you very much. I've worked so hard for my money, so I'm not willing to part with anything. But what it means is the higher the risk, the higher the return. But of course, for every investment, you need to arm yourself with data, a lot of research, ask people that have done it before, check their trend record. Thank God, if you go to SEC website or NGX, these things are open. You can read about a company or a business venture before you dive in to see. Then again, the last one is age plays a very important role because in the investment circle, right? What the analogy we use is the younger you are, the more risk you can take because you still have a lot of years ahead for you to make that money. So imagine somebody fresh out of school, NYSC, got a job earning, let's say, average 200K. He can afford to do some risky investments and say, you know what, if I erode 20% of this investment, I'm cool because he's just starting out his career. Entry level associate, he grows up the ladder and makes more money. Vis-a-vis someone that's been in the career sector, let's say 40 years or 45 years of age, approaching the retirement age, such person is not advisable for them to take on so much risk because your earning power is reducing. So the number of years you have technically to make more income is reducing. So you need to, at that age, you need to avoid risk per se. So that's why I have a graph here I want to show. Where are you? Okay, here. So risk versus return. So it says the lower the risk, the lower the potential return. The higher the risk, the higher the potential return. So that's how the scale is. To say if you're young, go outside there, take calculated risk, my people, not just any type of risk. Take calculated risk. Has it been proven? Or what are the underlying asset? What percentage is the risk involved in this investment? Who can I talk to? What are the mitigants to this risk and all that? Right? That's why risk and age are kind of associated there. They go pari passu. So your age kind of technically tells you how much of risk you can take in because the age will translate to amount of time you have left to earn more income in which you can invest. So back to where we started from for the mix of the investment. So I have the mutual fund, which is the safest of them all, kind of, right? Because let's be realistic. In life, there's no zero risk situation ever. There might be unforeseen risk. That's why even the banks and investment people will tell you force majeure or hand of God. I don't have control over the weather. It might rain all through, and the farm I'm invested money in, flood washes away. I have no control over that. That's so there's no zero risk. So what we try to do as much as possible is What is the minimal risk that's applicable to this investment or this business venture, and how do I mitigate it? If it happens eventually, what do I do? So for mutual funds, right? Like you said, it's mutual. It's like a lot of people pulling money together to buy assets. So I give you an example. You need to buy Dangote shares, right? Let's say we're working with 50,000, 100,000. I need to buy, rather than using all my 100,000 to buy Dangote share. I mean, I'm going too far. Let me bring it close to home. How do mutual funds work? Let's make an example with pizza slices. I think we'll be more comfortable with this than going into equity stocks and all that, right? So just think of it as crowdfunding to get a box of pizza. That makes it possible for everyone to have a slice without paying the full amount. So for instance, I need to get pizza. A large pizza costs what? For the sake of this discussion, let's say 10,000. But even if I buy this box of pizza, I can't finish everything. And if I say I reheat it tomorrow morning or some other time, it might not be as fresh as the first one. Option will be, do they have a smaller alternative? I can get it. Oh no, what if I want more than one flavor? Does it mean I have to buy 2 boxes of pizza at 20,000? So the idea is, oh, we're here. How many of us? 10 of us. That makes it what? We contribute 1,000 and we get a box of pizza. So mean you have 9,000 naira saved. And if you want another flavor, rinse and repeat. Oh, this is pepperoni. Okay, I want another flavor. I want beef fajita. Okay, you get the concept. So rather than using your whole amount, your whole fund to buy it, to purchase that particular investment, you're able to get bits and pieces of all other assets, which makes your portfolio diversified. So let's bring it close. Let's bring it back to investment. So we have mutual funds. So what mutual funds does is to pool funds from a lot of people, put it together, and buy you a Dangote shares, buy you Zenith, buy you treasury bills, buy you commercial papers. And another advantage again of it is if you want to invest on your own, then your limits, or rather your financial capacity, might not be able to afford it. So does that mean we'll cut you out of that investment? An example is Nigerian treasury bills. The minimum you need to have to purchase Nigerian treasury bill is 50 million naira in the primary market. So I know somebody is saying, Sa'id, you said let's start investing and you jump to 50 million naira. Apologies, right? So does that mean I can't invest in Nigerian treasury bill even after data has shown is one of the safest? Because this is being backed by Nigerian government and CBN. So the idea of mutual funds is, okay, bring what you have. Start from 5,000, 10,000, 20,000, multiple of 5,000. What we do at Vested is to aggregate all these funds until we're able to pull up to that 50 million, and we'll buy the treasury bill, which is our pizza, and everybody gets a slice. As against you waiting till you have 50 million to buy this treasury bill. Oh, I'll pause. Do you have any questions before I proceed? Okay, awesome. So I have this saying from my favorite lecturer while I was in school. It says, if the class or the audience are too quiet, you've done two things. Either you have super intelligent people and they don't have questions, or you bore everyone to death and they're currently sleeping, which is the case. Someone say something. Are we sleeping yet?
We're not sleeping. Very, very
Awesome.
awake. And you haven't bored
Awesome.
us yet.
Oh, that's comforting. That's good to know. So that's the idea of mutual funds. We pull this money together and be able to buy you high-end investment, which ordinarily you have to save a lot before you can achieve that. And this is better because the funds provide you with diversification, and diversification reduces risk. So diversification simply means buying multiple options of the same commodity. So imagine today I buy MTN shares, everything, and something happens to MTN. What will happen to my money? Invariably, something will affect it, right? So what we try to do in order to reduce risk is diversify. So if we do telecoms, 20%, we can go to finance, banking sector and do 20%. We can go to agriculture and do another 20%. So we can go to petroleum and do 20%. So the idea is these sectors can go down together at the same time, thereby reducing the risk, as against you putting all your money in a particular shares and the company goes down. And we know how fast news travel these days via social media, and this in turn affects investors' decision. Either they put in more money or they pull out. So if I invest in 5 companies and one has bad PR and investors pull out, I mean I have 4 other companies holding forts. It doesn't mean my money will go down the drain. So that's why we advise investors usually diversify. And because this diversification has a lot of underlying conditions. You need to consider the risk rating of this company. Are they A, triple B? How long they've been in business? What is debt to asset ratio? All the technical term. That's where vested comes in to say, you know what? You've worked so hard to earn this money. It's not fair for you to go back home doing research, newspaper, Google, calculator on where to invest. So vested to say, you know what? We're a fund manager. We take all this load upon ourselves. We do the maths and come to you with the best alternative and tell you, you know what, this is what you invest in, this is what you don't invest in. That's what we do. So so that brings us to collective investment scheme, right? So these are all variants of mutual funds. That's why we call them. The generic name is collective investment scheme. I remember we're working with risk appetite and also investment horizon. So investment horizon simply means the time. Okay, I have let's say my goal will take me 2 years to achieve. That's my investment horizon. Now I've calculated my disposable income. So this table just breaks it down for you like a summary. Or my investment horizon is 2 years. Oh, this fixed income fund, the one in the middle says horizon 2 years or greater. So what are the underlying assets? Oh, I have bond, I have corporate bond. What is the investment objective? Does it align with my own personal investment objective? Here, this product is seeking to generate stable income by investing in a diversified portfolio of debt security issued in Nigeria. So debt security is a fancy of saying, you know what, we're borrowing this money to other companies. They want to raise funds either for working capital or to buy machinery and other stuff like that. An example would be Dangote Refinery, Dangote Cement, Dufil Noodles, Coleman Cable. You know, we have a lot of them. But like I said earlier, Chidera and our team are working so hard daily doing all this research so they can bundle it together into an option for you to just pick at vested. So you don't even need to worry your head about what is the underlying asset, what is the need, where is my money going to, because they've told you this is the risk, no risk, this is your horizon. But the easiest one that has almost zero risk, right? Because in investment you don't say there's zero risk. There's always that risk there, but the one that has minimal risk that is close to zero is your money market funds. So this invests in treasury bills, commercial papers, bank placements. So these are all investments that has maturity less than 1 year. So the idea for investment is the longer you stay, the higher the risk to your exposure of your money. So a lot of people would rather do short term, repeat, put the money again, go, mature, continue that way. So for the money market fund, it seeks to generate stable income, maintain high degree of liquidity. It has low risks. So when you hear low risk, it is synonym with low returns. Now, don't get me wrong. It doesn't mean that when you put your money in money market, you get low return like 2% or 3%. No. When you compare it to the other funds on this table, the return you get is low. So for a balanced fund that is doing 30%, the money market can be doing the 12%. 12% on its own is huge. You agree with me, right? If you do 12% on 1 million, 12% of 100 million, 12% of 100,000, it is huge on its own. But if you now compare to a balanced fund that is doing a 32%, but has higher risk or moderate risk, so this is where your risk appetite comes in. So what are the risks involved with this balance fund? Is it a risk I can take? What are even the certainty? What are those factors that I see that tells me this risk will occur? Or what are the mitigants? What are the things I need to put in place if this risk should occur so I'm able to bounce back or not lose my principal in total? So for balanced fund generally, right, why they call them moderate risk is because they involve equities or stocks of company. And you know, stocks of company, are driven by economic factors. Like given the new change in government and monetary policy, the Nigerian capital market has been appreciating. It went from 23 to like 35% in just 30 days. So those that are already keyed into this fund are actually smiling to the bank now because it's a good type of risk. Nobody foresaw that this economic policy will be will have that positive effect on the market, right? So it's actually calculated. But in order to mitigate whatever risks that can happen to share and stocks of company, because it fluctuates up and down, so we said let's make a mix. Let's put a cushion. So we made the equity 70%, and the remaining 30% is made of corporate bonds and money market securities. These are items that are less than 1 year and they're guaranteed to give you returns, right? So we're saying even if equity market should go up and down, and 70% of your money is there, a portion, 30% of your fund is locked into the safe one that has zero risks, right? That will give you return come what meet. And the idea is to cushion the risk with equities if it eventually happens. If you notice, I emphasize on the if because it's unlikely to happen, but it's good to put it out there to be transparent to say, you know what, MTN is doing 17 naira today. Tomorrow it might be 100 naira. Next tomorrow it might be 20 naira. Depending on how much you come in, that is how it affects your principal. So I'll pause again and take questions if you have any. Awesome. I'm loving this class. Everything is just going. So, like I said, I'm sure everybody here has seen the interface of the vested app and every. So what we try to do basically is to do all the market research for you, bring data, use our own discretion as the fund manager to break down portfolio into minimal risk, conservative fund, and a high risk fund, just to show you this is the interface of the app. You can tell your friends because after today, trust me, I don't know about you, but I know you're going to leave here a changed person. You're going to become an investment guru, right? So the app is just telling you when you log in, you have the modal for invest, then it's asking you for new portfolio. Are you creating a new portfolio? You name it. So you know the idea about manifesting what you want. So that's what we put here. What is your investment objective? To protect the value of my capital, to achieve moderate capital growth, to achieve substantial capital growth. So this is we trying to know your risk appetite. Oh, this person wants to earn, ah, I'm trying to protect value of my capital. Even one kobo, I don't want out of my money. We have a place for you. Okay, I'm indifferent, moderate, not just too much. I can take the heat versus the promised return you give me. I'm comfortable. Then you know what? I'm all in. I just want the returns. Let's go. I can take this risk. So we already profiled that for you on vested. You don't have to spend time doing all this calculation yourself. Then of course we have the moderate funds and conservative funds. So you can see the returns for yourself. While a conservative fund is doing 11.22%, a balanced fund is doing 35.22%. Now you may want to reconsider that risk about the equity. 11 to 35, the difference is what? 24%. When I want to push more so I can get a bit of that 24%. But like I said, it depends on you as a person. What is your risk appetite? So unvested, once you log in, you create your portfolio, you give it a name. So we ask you, are you a conservative investor or a moderate risk kind of investor? If it's conservative, we have two funds for you here. If it's a moderate kind of risk, we have three. When it comes to high risk, we're still trying, we're deliberating in-house to see how we can mitigate the risk on those high-end products with high risk and present it to you so you can buy, so that you can sleep well at night. You know, let Chidera, myself, and Chidima take the burden off of you, right? So as soon as we're able to profile that and we see, okay, this is the risk we've identified, we have mitigant in place, we'll also put it up here for you so you can invest in them. But for now, you want to go with me that earning the 35% per annum on the product is almost too good to be true. I mean, that is awesome. Giving you 35% of a principal back. And imagine if you've invested this fund and you keep doubling with the interest and you continue investing. Or hey, you decide to do this with your partner, you know, a kind of joint investment. And aside from increasing the family bond, you also have your money growing double, right? So the open-ended schemes is the Cora Money Market Fund. Minimum cost here is 5,000 naira. But the way we've structured it invested is just bring in your principal you want to invest. We'll worry about the back end calculation, but you're saying the minimum investment here is 5,000. We want to be able to accommodate everybody. And the good part of this fund is you need your money back. Just give us 24 hours to sell some of this asset we've purchased at a cost and give you back your money. I mean, what can be better than that? Right. So let me see. Yeah. So I didn't arrange the slide, but I'll come back here. So on this part of vested, right? Anybody, do we have questions on conservative fund and moderate funds? Anybody curious as to why one is doing 35 and the other is doing 11?
Hello, Said.
Yes, please.
Yes, and this is Akoma. I have a question. So I got to the conservative fund screen from the app. So I
Okay.
see there's like an important information here, and then it says, please note that the returns advertised are historical and are not indicative of future performance of the mutual funds. Can you just explain what that means?
Okay. I put that one on Chidera. She was trying to play smart and give you big English. Right. So what I'm telling you that these things are historical. So the way we calculate
Mm-hmm.
returns of these funds is daily, right? So what it means is today the fund might be 11%. Tomorrow it might be 13. Next
Oh,
tomorrow it might be
okay.
10.
Mm-hmm.
Next tomorrow 15, 8, 7. But the good thing is at the end of the month, 30 days, we'll take the average return and that will impact your principal. So the idea now
Okay.
is I don't want you to come in now and see 11.2 and you invest, and tomorrow you see 10.9, and you call me up and say,
Mm-hmm.
Said, you're not transparent. I came in at 11. Why am I seeing 10.2? So I'm just telling you these are historical performance, and this does not
Mm-hmm.
predict the current earning because you know I buy and sell this asset, and government policies and other things affect the returns in general. But what happens is at the end of the month, you get your cumulative return applied to your principal.
Okay, got it.
I
Thank you.
hope I've been able to convince you and not confuse you.
Thank you. I get it.
Yes, yes. So for the moderate funds that's doing 35%, right? Remember, it has 70% of equities, which is shares and stocks of businesses, right? So we don't just go out there and buy any share of any company. Oh, MTN is yellow. I like the color. Buy this. Or Airtel red. Ooh, my favorite color. Buy this. No, no, no. We do due diligence. We have data as far back as 5 years, 10 years, depending on how long the company has been existing. The debt to asset ratio. How much has this company borrowed vis-a-vis the money they have to run for themselves, right? Are they in a sector that I'm comfortable with? Are they into gambling, for instance? If you have any company that has gambling as part of the asset, that's the red flag already to say, okay, this can be Baba Jebu, tomorrow it might go down. So I have um, very competent team of analysts working day in, day out to study what these markets are doing. You have the likes of Mobile, you have MTN, you have Airtel, we have Total, just a mix up of all sector, right? To also diversify that field. But we're just putting out there because we don't have control over the fluctuations and the prices. That's why we're saying, oh, this is the risk attached. And we also have mitigants, right? So when they say moderate funds or high risk, it not necessarily mean, oh, the stock will drop tomorrow. But we're telling you, no, there's a possibility this can happen. But the shares of the company we selected, trust me, they're handpicked. And I'm just saying we're comfortable putting it out there. And you see, given by the difference by other products, you can see the margin, yeah, on the returns we have here. So feel free, set up your plan. Remember the 50-30 rule. Yeah. So 50% needs, 30% wants, 20% investment, or you can flip it however you want it to work. And hey, we're social. I'm everywhere you are. TikTok, email, Twitter, LinkedIn, Instagram. You can talk to me anytime. So, or take questions if you have
I
any.
have a question.
You go ahead, please.
Yeah. What if I'm interested in real estate investment? Because you didn't say anything about real estate.
Yeah. So the
Yeah.
idea with real estate is we have consultants depending on the sector. Hold on, let me find that slide. Just 1 second. Yeah. Depending on the sector you want to go into, we have analysts and consultants on this part. For the real estate, we have a consultant we can work with depending on the principal. So why you seem kind of quiet about real estate bonds and treasury bills is because these are capital intensive. For treasury bills, 50 million and above, you know, for bonds, they are long dated, 3 to 5 years horizon. And of course, real estate, is long term. But of course, if we have that, you can send an email to Chidera or one of our handles, and we'll take it offline and try to profile what will work for you.
All right. Thank you.
Okay, I was about to ask, does that address your question?
Yeah, it does.
Okay. So questions, please. Observations, contributions. We're all here to learn.
I said, can you hear me?
Yes, go ahead, please.
Okay, Ms. Chidera, so it's 12 o'clock and we promised that the class would be an hour long. So we can take the rest of the class next week when we come together again. I don't know if you have other slides that you want to address on the call, or we're stopping here for today.
For today, yes, for today I've addressed it. We're taking it in tiny bits so we don't overwhelm our audience.
Okay, cool. Okay, thank you.
Yeah.